Are covered calls risky? Have you ever wondered if covered calls could be a smart move for your retirement investment strategy? Let's break it down and see what you need to know. Covered calls are generally seen as a lower risk option strategy, especially when it comes to retirement investing. This strategy involves owning a stock and selling a call option on that stock. By doing this, you give someone else the right to buy your shares at a specific price, known as the strike price, within a set time frame. Since you own the underlying shares, your obligation is covered, which helps limit risk compared to selling options without owning the stock. However, there are some risks to consider. First, selling a covered call limits your upside potential. When you sell a call option, you receive a premium upfront, which can provide some income. But if the stock price rises significantly above the strike price, your shares may be called away. This means you could miss out on further gains beyond that price, which can be a big opportunity cost, especially in a strong bull market. Next, there is the downside risk of the stock itself. While the premium you receive offers a small cushion against losses, it does not protect you from a decline in the stock's value. If the stock price drops significantly, you will still face losses on your shares, minus the premium you received. So, while covered calls provide some income, they do not eliminate market risk. Another risk is the potential for your shares to be called away. If the option is in the money at expiration, meaning the stock price is above the strike price, your shares will likely be sold at that price. This could force you to sell shares you might want to keep, which can have tax implications and affect your overall portfolio. Now, let's talk about income and tax considerations. The premiums earned from selling covered calls can create a steady income stream, which is especially useful in retirement. If you hold covered calls in tax-advantaged accounts like individual retirement accounts, the premiums can grow tax-free or tax-deferred. However, if you hold them in taxable accounts, those premiums may be taxed as ordinary income. From a retirement perspective, covered calls can be a helpful strategy to generate additional income on stocks you already own. This can supplement fixed income and help reduce portfolio volatility by providing a steady cash flow. This strategy is often best for investors who are comfortable holding the underlying stocks and can handle some downside risk. In summary, while covered calls do carry some risks, they can be a suitable option for retirement investing when used thoughtfully. They can help generate income and manage risk, but it is essential to keep in mind their limitations regarding upside potential and exposure to stock price declines.